Wonderful good evening to everybody. It's a great pleasure for me to welcome you in this webinar, this Wednesday evening webinar, education webinar by Admiral Markets, one of the best broker you can choose for your own trading. And yes, I hope you had a great day and a great trading day with a lot of success. And yes, now we are together here for the next step, the next topic we want to talk about, and that is the trend. Part one this day on Wednesday, the 29th of August, almost done. The August time flies, and yes, that's the reason I always say focus on your life. Trading is an important thing, but not the important thing in your life. So how does the trend develop? This is part one, and we want to talk about the trend creation. And yes, but first I have to show you, so where is my mouse? There's my mouse. I have to show you the risk disclaimer. You know, Forex CFDs are complex instruments and come with a high risk of losing money rapidly. 83% of retail investors' accounts lose money when trading CFDs with this provider, Admiral Markets. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. This is your own responsibility to take your risk. And since August 2008, the regulation within the European Union differs for retail clients and professional clients. In this presentation, we use only demo because we have only slides this evening. And before opening a live trading account, please consider the differences between retail and professional trading terms. And here, why do you have to choose Admiral Markets? Best index offerings by DAX 30, best offerings of Euro, US dollar, best order sizes, best order execution, no minimum stop distances. That is really important, ladies and gentlemen. No minimum stop distances or requotes. That is in a successful trading really, really important. So this is ESMA important changes for Forex and CFD trading. So on the right side, you can just see the difference in the requiring of the margin. So, and you can choose between retail client and professional clients. So these are the contact information about so how does the trend develop, the trend creation? We want to talk about this evening about movement and corrections. About the trend is always there. If you look at your chart, you can see the trend always, every time, in every chart. But how does the trend develops basically? And how is responsible for the trend development? All these topics are included in these 4 parts of this topic, this main topic, how does the trend develop? And today, we want to talk about the basic. So, and the share, this is one of my special sentence, the share you buy today with confidence is being sold to you by someone who is as sure of himself as you are. Ladies and gentlemen, dear listeners, welcome in trading. This is so much important because you have to know trading is a marketplace. You want to buy, you need another one, he wants to sold. You want to sell, you need another one of the other part of the market, you want to buy. But you are confident to do the right one, but your part on the other side is confidence as well. So welcome in trading. This is one of a really, really great sentence in my private opinion. So before we talk about the trend, we need to talk about the basic, and the basic in trading is unbelievable, the 6 tenets of the Dow theory in our age, in modern age. So Dow, Mr. Dow published this tenets in the year 1873, I guess, yes. And that's the basic in trading, the absolutely basic in trading, ladies and gentlemen. So, but how can we use this tenets in our modern age, in the 21st century, in trading with order book, with volume, with whatever? But there's no way to avoid the tenets of the Dow theory. Let's start with the first tenet, my dears. So the first tenet, the averages discount everything. So everything what supply and demand influences, you can see in the chart. You don't need, and this is really revolutionary, you don't need fundamental analysis. Big scream of the fundamental traders. Yes, but let me tell you something. If you are a fundamental trader, you visit the company, you talk to the CEO, you talk in secret to the secretary, you know what do they have in the pipeline, and you can have every information about a company, the shares you want to buy. At the end of the day, you have to call your broker and you have to tell him, buy me this share or sell it. And I can see it in the chart, no more, no less. So I don't talk to the CEO. I didn't talk to the secretary. I didn't know what kind of stuff they have in the pipeline. I didn't know anything about the shares or the company you want to buy or sell. But I can see your order in the book map and finally in the chart. So everything what supply and demand influences, you can see in the chart. It's either you are weekly trader, monthly trader, daily trader, the alpha and omega, the 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 beginning and the end is the book map. So, and finally the chart is the following stuff of the book map. The tick chart is the mother, or the order book is the mother of the chart. So everything you can see in the chart. So the averages discount everything. This is the first tenet you have to need. So next one. Every market, every chart has three trends. The major trend, it's a long term. A medium trend, this is a medium term time frame. And the small trend is a short term. So for Mr. Dow, where the most important thing was the major trend. He only looked at the major trend. The medium trend was for him a really small trend, and the small trend was for Mr. Dow it's absolutely nothing important. For Mr. Dow was the big trend, the major trend, the most important thing in the chart. So an uptrend basically is defined by a higher highs and higher lows, and a downtrend is defined by lower lows and lower highs. This is the meaning basically of a trend. So, and in every chart, in really every chart, you can see three trends. In one of the next parts of this education series, we are going in practice. And then we have to make exercises. We want to paint trends together. Then you can see and then you can educate your eyes for the chart. This is really important because the trend is the end, the beginning and the end of every chart. So next tenet. The major trends have three phases. Note it. Accumulation phase. The market rebounds after a correction, and experienced traders and well-educated traders decide in the accumulation phase to buy or sell, whether is it an up or downtrend. So, and as you can see, the accumulation phase is the most important phase ever. Because it's like, let me give you an example. So maybe you go to the U stations, to the underground station. So, and that's the beginning of the drive. So you can see the train station. You can see the train. No one is inside of the train. You are the first one. You go inside, you take place, you know, sort of sit down there. And now there are two options. Either a lot of people come to, sit down, and the train is going to drive. Or the second option, the train doesn't want to drive. So the bad thing, you have to go out of the train. So that's all. But you are the first one, you are sit in the train. That's the accumulation phase. So, and if the train doesn't drive, you have a stop. At your stop, you can go out of the train. This is the accumulation phase. You are maybe the first one is in the market, and then the market or the trend, the next move will come. So this is the accumulation phase, and only experienced traders or well-educated traders decide to buy or sell in that accumulation phase and have their stop very close below or above this accumulation phase. So the next phase is the progression. The market starts the next move, and a lot of traders jump in the market. But you are in the train already. So, and this is really important. This is one of this is one of the most important questions ever, ladies and gentlemen. You have to look, where is the bus? Who wants to buy after you? So if you are the one and only in the market, maybe you are the hero. But if there don't come any other traders to buy or sell in the same direction like you, that's a bad thing. So you need the possibility or the probability to figure out where's the place where a lot of other traders come in and forces and make the movement stronger. So this is really simple. This is the phase of progression. You can see the market rebounds, accumulation phase, and after that the progression phase. So the move is started and a lot of traders jump in the market. So after that, the distribution phase. The market is now very strong. The move is running and running, and you can read it in the newspapers or on internet. Oh, this share increases about 10% or 20%, and everybody wants to be a part of the next run. This is the distribution phase. But in this phase, experienced traders and well-educated traders go out of the market in the distribution phase. Don't forget, trading is a marketplace. So if you have a lot of people they want to buy, you need a lot of people on the other side, they want to sell. This is trading. It's marketplace. Don't forget it. So, but you can sell your shares or buy. It's either you are long or short in the market, because you were the first one who sit in the market or you sit in the train, because you were inside the market since the accumulation phase, and this is the price in the distribution phase. You are a winner. Your account is in a winning zone. Now you can sell very, how should I say, comfortable. So these are the three phases of every trend, especially the major trend, but you can see it in every trend. So maybe look at today, look at the Dow. What a great move. So a distribution phase. We started around about 26,055 points. And now we are 26,174 points. So the accumulation phase we saw in around about 26,055, and now at 26,130 roundabout, the distribution phase. Wow, the really big move jumps to the high. This is the distribution phase. It works in every trend. It works in every damned chart. So I hope it's a little bit helpful for you to know, and this is really important. Before you want to go inside the market, before you want to make a trade, you have to figure out in which phase you are right now. Because if you can see you are in the move, it's the wrong phase. Because after every move, the next correction will come. This is a tenet, this is the rule of the market. So figure out on which phase you are before you want to go inside the market, before you risk your money. This is an example. Look at this one. Below this, you can see this is in the Dow theory. We say a high, a special high, a current high is the 0.2. This is my wording in my trading education service. And a correction point is the P3.3. So we don't count above 3, 4, 5, 6, 7, 8. No, every high is, or low, whatever, is P0.2, and the correction point is 0.3. So, and here you can see this is the 0.3, and you can see here's the accumulation phase. I know it's written wrong because it's a duplicate from the German. Here, but you can see, I know you are very smart. You can see it. This is the accumulation phase, ladies and gentlemen. Sorry, just a moment. This is the accumulation phase here. The market is correcting, calm down, and rebounds. And this is the point where well-educated and experienced traders go with their orders inside of the market. Mostly the people, they have more money because the smart money is able to rebound the market, to progressing the market, to take it in the distribution phase. But the smart money go inside of the market in the accumulation phase. So this is, so in our wording in the Dow theory, but working in the Dow theory, we have there the phase 4. Correction phase is always phase 4. After that, when more people jump in the market, the progression phase starts. This is phase 5. Ladies and gentlemen, the phase 5 is the best phase you have to choose if you want to go inside. Accumulation phase. In the space between accumulation phase and the last 0.2, there takes place the best moves. There you can make your money. And if the price goes up above or in the downtrend below the 0.2, this is the distribution phase, the phase number 3. So it's easy to remember. Accumulation phase is phase number 4. Progression phase is phase number 5, the best phase, outcoming of the correction in direction of the trend. And below or above the point 2, you find the distribution phase, and is the phase number 3. So, and you can see it. Maybe look at your charts. We do that next Wednesday, sorry. Look at your charts. In every chart, you can see the same procedure. In every damn chart, you can find accumulation phases, progression phases, and distribution phases in every chart. And you can see the space between correction point and point number 2, the last high, is the best phases. There takes place the best moves. Not 100%, but mostly. The next tenet. The averages must confirm each other. If you want to trade in the, for example, if you want to trade in the hourly chart, the daily chart must confirm the hourly chart. So the leading trend in the higher time frame. Oh, there's a mistake, as you can see. The leading trend in a higher time frame should support you or must support you. This is the better choice for you. So the averages must confirm each other. And so the probabilities for a trend continuation is placed about around 65%. But if you make sure that the leading trend in the higher time frame, maybe the daily chart, is running in the same direction like the hourly chart or as the hourly chart, the probabilities increases to 72%. It's a little bit different, ladies and gentlemen, and that is really important. So remember and figure it out and make sure that if you want to go inside of the market and you, for example, you want to go long, whatever, it's not a good decision if you want to go long in the hourly chart, but the daily chart shows you a downtrend. And maybe it's the daily chart is in a correction and is starting a movement to the lower side and you want to go long. That's stupid. That's a bad decision. So figure out and make sure that the higher time frame is running in the same direction as you want to trade. The volume must confirm the trend. So the volume must increase in direction of the leading trend. That's really easy. If you want to make a long trend, you have to make sure that your volume supports you and you have a great volume. There is a point where the count of the volume and where the people count the volume, you can see it with volume indicators, yes, that they support you. So it's not a good decision if you want to make a long trend and there's no volume there. Yeah, you want to make a long trend. You need a lot of volume that the movement can start. That's really important. And this is also a part we want to talk about in this education series because it's really important. So, and the last tenet of Mr. Dow was, a trend is assumed to be in effect until it gives definite signals that it has reversed. Let's repeat. A trend is assumed to be in effect until it gives definite signals that it has reversed. It's the same sentence when I say a trend continuation is more likely than a trend break. So Mr. Dow thus describes the inertia of the trends on the basis of physics. And there's a rule, the probability is that the existing leading trend will continue as long as the trend not too major. That's another important information, but this is the part we want to talk at a later time. So, and this is the last tenet, a trend continuation is more likely than a trend break. I hope this was helpful, and now we want to figure out how does a trend develop. This was the six tenets, and now we want to talk about how a trend develops. So, you know, we talked, you know this picture, we talked about it last time. So we have a lot of traders in the market. We have traders that make arbitrage. We have traders that make hedging. We have traders that make fundamental trading. And there are you and me. Mostly we are normal traders with different time frames. Maybe you are 1 minute trader, 5 minutes, 10 minutes, 50 minutes, 60 minutes, or maybe you are a part-time trader and you are in the market with daily, hourly, weekly chart. But all of the traders, all of them, really all of them have a meeting in the bookmap. Ladies and gentlemen, this is so damned important that you know that. And all of these people, all of that traders are responsible for the trend. They created the trends, they make the trend progressive, and then they make sure that the trend can rebound, go into a correction, and next movement. All of that traders, and of course, you and me too. That's important. So, you know, and I think you know that we have three parts or three kinds of traders. You see it on the below slide. We talked about technical, the normal traders, fundamental, arbitrage, hedging. But all of them are in the market. Either they are long or they are short. But that's not important, because if you are in the market and if you are long, in a long position or in a short position, what can you do? What can you really do? Nothing. Nothing. The only thing you can do is to go out of the market. But especially if you are long or if you are short, you can do at that moment, if you are inside of the market, you can do nothing. The only thing what you can do is waiting. Waiting what will happen next. So the most, ladies and gentlemen, the most important kind of traders or group of traders are not the traders, they are in the market already. The most important traders are the flat. Now you might say, why flat? They are not inside of the market. Yes, of course, they are not inside of the market. They are standing on the sideline. They are thinking about, where can I go in the market? That's the people, they make sure that the trend is starting. That's the people, when they come inside of the market, they make sure that this movement starts. Not you and me, because we are in the market already. We have to wait, and we have to make sure before we go inside of the market that the people they are standing on the sideline, that they want to go inside the market in the same direction you want to make your trade. That's the reason why the flat people, the flat traders, the money who is on the sideline, to want to go in the same direction like you. That's the reason why the part of traders, the group of traders, they are flat, they are not inside of the market. That's the most important people. So if you think a little bit about that, then you will recognize that you have to think about that people, the flat people, before you want to make a trade. You have to make sure that there will come a lot of traders with the same intention like you, with the same idea to make trades in the same direction like you. And this, my dears, this is your job. It's not your job to go inside, outside of the market. Your damn job is to make sure that at that place, at that spot where you want to go inside of the market, that's the right spot, probably the right spot with the highest probabilities. And after that the next people see, oh, that's the right direction. I come inside in the market too. So this is a really important thing. Maybe this is one of the most important things where you have to figure out where are you in the market. Basically, it's nice to have a trade. It's really nice. It's easy to make a trade. Put on the enter button and you are in the market. But it's not so easy to figure out where are you in the market. Basically, if you are in the move, if you are in a beginning correction, if you are deeply in a correction, or wherever you are. And this is your job. And maybe if you follow my weekly webinar at Admiral Markets in English tomorrow at 11, yes, tomorrow at 11, you can see if I want to make trades, I always looking at the daily chart first. This is my first view at the daily chart. I'm not interested in the hourly chart. Not before I have a look at the daily chart. Because I have to know and I have to make sure where I am in the market. Am I in the movement or am I in the correction? And I'm only interested if I'm in the correction, because a trend continuation, listen, accumulation phase, accumulation really is important, is the best phase, phase number 5. You know, correction 4, movement 5, and distribution phase. People, they are short, long, or flat. Oh, I'm missing that flat above, but you can see it. So at any point in the market, maybe after a trend break or after a special point in the market, so like Fibonacci or like somewhere else, a trend starts. And you know, we talked about in the topic, how does the price develops? If you have more buyers than sellers, a price increases and the trend starts. If you have more sellers than buyers, a trend starts the correction. So at any point in the market, the trend starts on the next movement. So, but why don't so many people go inside in the market in the accumulation phase? What's the reason? I can tell you the reason. It's a problem in our brain, because we are human. We are humans. We are human people. We need safeties. Most of the people, we need yes, safeties and securities. We try to avoid risk. But if a trader can see, oh, there's a movement, oh, there is a movement, and the movement must continue, I have to go inside in the market. If you can see it on the weekend in a weekend paper, maybe a share increases in the past week about 10%, for example. Oh, you can see it in the newspaper, or you can see it in a list on the internet, the best shares, the bad, the worst shares, whatever. Oh, you can see the best shares. Oh, increasing 10% in the past week. I need to have this this share. But the people forget that there was the increase was in the past. But you need safeties, you need securities. So, and at that point, the people forget that trading is a marketplace. Stock exchanges are marketplaces. And if you want to have this share after a 10% increase, you don't have to forget there's another boy or girl on the other side who sells you this share. So, and at that point, after an increasing market, you know, distribution phase, progression phase, people jump in the market and get the shares or whatever future contract or some Forex, whatever, doesn't matter, from the people they were inside of the market since the accumulation phase. And you know what happens after a movement. What does happen after a movement? Of course, the next correction will come. And that's the problem. At a special point, unexperienced traders, not stupid people, that's not the meaning. Unexperienced and not well-educated traders go inside of the market after a move, not before. Because there's no safeties in accumulation phase, there's no securities. I want to see that the move is running. Then unexperienced traders come inside of the market. But they forget that of the other side of the market is one people who sell what you want. And this people is mostly in the winning zone, because these people were inside of the market before the movement starts. So, and then, so for example, after 10% increasement, you buy. You go inside, oh, the market is green. So I have to go inside of the market. Now you are inside. You were flat and now you are long. For example, we talk about the long trend now. You are long now. Whew. You are happy. I'm inside of the market. I have this share now. So Monday is coming. Fuck. Sorry, that's reality. Trader who only jumps on the running move, they're crying. Why? Because they have forgotten that after a movement, the next correction will come. It's a game, it's the normal game of trading. After the phase of distribution, more buyers, more people want to sell because they are in the winning zone. They said 10% on my account, I'm done. I have to go inside. And you need one who want to sell, who want to buy. And not so well educated traders go inside of the market in the move. Trader who only jumps on the running move were crying now, or are crying now, because the price is correcting. So imagine you have this share You were reading it on the newspaper. Oh, this share increases 10%, and I want to have it. So now you have the share in your account. Monday is coming, Tuesday is coming, Wednesday is coming, and you can see it in your account. Fuck, loss. Why? It's a loss. But that's trading. After a movement, the next correction will come. It's really easy. So now the people are crying. Oh, I made the wrong decision. Oh, always me. Why always me? Always I'm inside of the market. The market makes the wrong decision, makes the wrong direction every fucking time. That's the experience of most of the traders. So, and at that point, the correction is running. Do you remember? Accumulation phase. After a correction, people, they sold on the higher point, they can see, oh, the price is decreasing. How nice is that? I get this share more cheaper again. And you are in the loss zone. You have a loss. And you said, oh, Jesus Christ, oh my gosh, I'm in the loss. I have to sell. I have to sell the share. Before I make more losses, I have to sell. Okay, no problem. Because there's waiting other people. The experienced trader, the well-educated trader can see the decreasing price. And they said, come on, give it to me. Give me this share. It's cheaper for me. And you were crying and said, oh, I have a loss. I have to put it away. Throw it to the window. The meaning point is the most important thing, get it out of my account. No more losses. Okay, no problem. So at that moment, you are flat again. Okay, you understand? You are flat. You sell and you are flat. Now, how often do you make, or how often did you make the experience that after you go, or after you went outside of the market and you are standing on a sideline, how often did you make the experience that then at that point the trend is running again? Did you make that experience? I swear to God, you made it. It's one of my worst cases, my worst experience ever. Always. It was always the same procedure. I go inside, the market correcting. I go outside, the market is running. Always the damned same game. But what happened? Trading. Now you know why we build up this education series. How develops the price? How does the price develop? How does the trend develop? At a special point after correction, more people see the decreasing price and want to go inside. But the people that jump inside of the movement, they are in the loss. And they say, go away from me, go away, take it. And now the accumulation phase, the rebound in the market goes over in the next progression phase, phase number 5, from the correction point to the last high point. More people see it, jump inside, progression phase, distribution phase, and you are not a part of the move because you decide to sell. You are flat. You are on the side. More people go inside. They can see, oh, there's a trend. I have to go inside in the market. And maybe next people see, oh, there's a movement, the next movement, I have to go inside of the market. You are standing on a sideline. You are not a pot. But now you can see, oh, damn, I was wrong. I sold at the worst point. But now my direction I want to go is now valid. So you're standing silent, you make the next decision. Oh, it's the right decision. It's the right direction. I want to go inside of the market. Because you need securities. You need safeties. You want to see that the movement is running. So now you are going inside of the market again. And trader who only jumps to the running move were crying at that point twice time. First, they were crying, they sold the position at the worst point ever. After that, they could see, oh, damn, the trend is running. That was my direction. It was my direction. But I'm not a part of it. But now you can see, oh, I must go inside of the market. So now you can see this big move. You go inside, but one point you have forgotten. On the other point is one who sold, who want to sell. You want to buy, he want to sell. You have it, you want it, you have it, got it. Now you are inside of the market. You are happy. As long as you can see that. Trader who only jumps on a running move were crying again. What happened? What happened? That's trend, ladies and gentlemen. That's a damned trend. It's only a trend, no more, no less. Most of the traders forgot that after the move, a next correction will come, because it's the game of supply and demand. And if you remember that, you can avoid a lot of mistakes. I swear to God, you can avoid a lot of mistakes if you find out where are you in the market before you go inside. But the people who jump in the market in a running move are in the loss after the correction, and they're crying again. So imagine it was you. At the first point you buy the share, then you are in the loss. You sold, and you have a loss. After that, you can see, oh, it's my direction. What's my direction? I have to go inside of the market. So you buy again. After you buy, maybe it goes a little bit more in your direction. You are happy. Oh, okay, winner. But after that, of course, you are in the move. Correction will come. Next loss. And I swear, you sit in your office at home, and I can tell you how many mouses and how many keyboards I put it on the wall, or I put my hands on it, because I was so angry in my beginning of my trading, and maybe it was very emotionally. Trading is a very emotionally part of is a very emotionally thing. And most of the traders makes this experience. They are inside and the price is going down. So now imagine you have this share again. And now you have the second time your loss. And you sit in your office and you think, oh, fuck. Why always me? Why always me? Always the same procedure. Where is the cam? Where is the cam? Who is watching me? Who is watching me? There must someone watching me, because I didn't always the same. I didn't do always the wrong decision. So now you are very angry. You said, oh, wrong again. You sell your position before, because you have a lot of fear. You make more losses. You sell. You know that feeling? Sell. Oh, thanks God, I'm outside. Stand on sideline. Maybe after a week, you open your newspaper, you show it your shares, and you can see that. Do you know that feeling? Do you know it? You go outside, or you went outside, and after a little bit time, you look at the same chart, and he makes the same direction as you want to have. And this, ladies and gentlemen, is a trend. Trader who only jumps on a running move, we're crying again. This is the reason why so many people loses money in an increasing market, because they always make their trades on the wrong point in the market. My dears, if you are looking for safeties or securities, believe me, trading is the wrong place for that. Trading is a game of probabilities, no more, no less. If you want to find securities and safeties, let it be. Trading is not your thing. Let it be. Trading is a high risk thing. It's only a game of probabilities. And people failed because the real challenge is not in the chart. You can see the trend. Probabilities, the challenge is taking place in your mind. Because people basically are looking for safeties and securities. A great car, a nice house, maybe the right woman, maybe, or man, whatever. Now you have a little bit more securities and safeties, but not in the market. I hope you understand it, and I hope I could explain it to you understandable. I hope you have some aha effects maybe, and I hope you were satisfied with me with the explanation. Next Wednesday we have the next point, then the part number 2, how develops the trend, and I can promise you it will be more interesting because we want to look into the market and of the charts. I want to say thank you for your attention. I wish you a nice evening, or wherever you are, a nice day and a great week, a great rest of the week. So take care for yourself, and we want to see each other maybe next Wednesday. Thank you very much. Take care and enjoy the rest of your day. Bye-bye.